This is Shelley Craft coming to you live on SNN Live. We're at the Sprott Natural Resource Symposium 2017 in Vancouver. I have with me Rick Rule to do a Wall Street view. He's with Sprott US Holdings, a publicly traded company, SII, on the Toronto Stock Exchange. Rick, welcome back to SNN Live.
Shelley, on behalf of the Sprott shareholders, it's a pleasure to have you here at our conference.
Thank you for having us. This is, again, just another giant leap for mankind, you know what I'm saying? So, Rick, I want to start with giving you the opportunity, as we do at every Sprott conference that we come to, for your State of the Union on the resource market, if you would.
This will be easy. You know, Shelley, and I don't need to tell you, the junior resource business has been through a tremendous bear market. The Toronto Stock Exchange Venture Index was off 88% in nominal terms, probably more like 92% in real terms. What investors need to recognize is that bear markets are the authors of bull markets because this is a capital-intensive business. The consequence of that is that this tremendous bear market will at some point in time give way to a real bull market. My belief is that the bear market really ended the end of 2015. Specifically, I think with regards to precious metals and precious metal stocks, that we're in the third inning of a 9-inning ball game. In other words, we're a third of the way through. The recovery that we had in 2016 was pleasant and dramatic. The market's faded since then, but it's important to remember that we're in a stretch. It isn't like the game is over. With regards to the rest of the resource sector, we're in the first inning of a 9-inning game. It doesn't mean that recovery happens in a period of time that's comfortable for your listeners, but it is inevitable, even if it's not imminent.
Now, we've been around a while in the markets, and I kind of see that, you know, the New York index, the New Dow Jones Industrial Index is going up, breaking records every single day. But I'm seeing that gold is creeping up also, which is very unusual. Silver has seemingly creeped up even more on a percentage scale. How do you, I mean, you know, when was the last time, you know, and the dollar is weakening. I mean, you know, this is an anomaly to me.
I'm not smart enough to understand all of those correlations. The correlation that's made sense to me over time has been that the delta between the U.S. 10-year Treasury and the 10-year Treasury strip, which is the market's implication of the real yield in the U.S. 10-year Treasury, determines the gold price. When the implication is that we have negative real interest rate, the gold does extremely well. What's interesting about the last 18 months, as you point out, is that gold did well at the same time that the U.S. dollar and the U.S. 10-year Treasury did well. In my experience, that happened first in 1975, secondly in 2001, and this is the third time in my 40-year career that I've observed this phenomenon. What's important for your viewers to understand is that in the prior two instances, the dollar eventually rolled over, which, as you point out, it may be doing now. And the consequence of that was that the gold price soared in the aftermath of that circumstance. Is past prologue? I don't know. I'm not an economist. I'm a credit analyst. What I do know is I've seen this circumstance twice before, and the outcome, from the point of view of gold holders, not U.S. bond holders, was very pleasant.
On topic, I see that some of the juniors are starting to bump up a little bit. Now, I don't know if it's because the U.S. investors are starting to be attracted to this pricing of gold and they're looking for opportunities because some of the other sectors are so overpriced, you can't, you know, you're buying toppy, you know. So, you know, bottom feeders, you know, not so much, you know, if they've been buying gold outright, that's one thing. But now all of a sudden you're seeing volumes pick up, and usually volume precedes price. Am I correct?
Three answers to why. First, the market was oversold. And some of the response that we've seen is seller exhaustion. The second thing is that it takes a long time to profitably deploy capital. And the last investment cycle that we had in this universe was the middle part of the last decade. The capital that was employed in 2004, 2005, 2006, 2009, 2010 is now beginning to bear fruit. In my experience over 40 years, it takes a decade, 10 years, for district exploration to begin to yield discoveries. 10 years ago, we began exploring in places like West Africa and in the deep parts of Eastern Australia. The consequence of 10 years of focused exploration is we're now starting to enjoy the results. And the consequence of that is, of course, the news that drives share prices. It's important to remember, in terms of a market that was as sold as these stocks were, that you can move up on fairly low volumes because you exhaust the sellers. The stocks have come to be in very, very strong hands. Hands that will not trade the stock for a 10 or 15% gain. Hands that will be looking for 50% and 100% increases. I'm not suggesting that those increases are imminent. What I'm suggesting is that the sector, the better companies in the sector, are extraordinarily well owned relative to other larger, more popular sectors.
Now I'm going to hit you with something off of gold and silver. The greening of energy, let's call it, where little known fact to most people is, lithium is less used in a battery than copper.
Correct.
Or cobalt or nickel. So how is that affecting the base metals in your opinion?
Well, I think most of the impact is in the future, with the exception, of course, of the cobalt price, which has done very well. And you point out something very interesting. The lithium-ion battery by value is 4% lithium. In other words, it's a copper-nickel cobalt battery. Interesting also that the world's four major lithium producers, estimate that collectively they have 100 years reserves at current lithium demand. We don't have a shortage of lithium. We have a shortage of lithium processing capacity. And at these prices, that'll be addressed in a 2 or 3 year time frame. Many companies that purport to be looking for lithium, in other words, that don't have any lithium, believe there's a lithium shortage. And those companies which do have it believe that there's a surplus. You need to decide yourself which side is more credible, those that have it or those that don't. Moving on to the rest of the battery metals, this is exciting, particularly from my point of view, cobalt. The problem with regards to cobalt is that you don't find cobalt in countries that you're comfortable with. You find cobalt in Congo and Russia. What everybody wants is politically secure cobalt. The problem with that is that politically secure cobalt is a fantasy. You want a great country and you want cobalt. Okay, you want a date with the 4 prettiest girls from Victoria's Secret. What you want doesn't matter. It's what you can have. We are attracted to the cobalt space, attracted enough that we're investing in Congo and we're investing in Russia.
But I understand that when you're hunting for copper, you could end up finding nickel, cobalt, and other elements.
Absolutely true. And one of the things that we hope to do is assist companies exploring mafic and ultramafic horizons for whatever happens to be there. And that could occur, as example, in lateritic terrains in Brazil and Australia, which would be very nice. Believe me, I'm not a slave to Congo. It's just that when I look for cobalt and I look for copper, I look for places where it's available in grade, and that's often in challenging countries.
So here we are at your conference. What are you saying to the investor audiences when you're in front of them?
I'm saying that you have been through 5 very, very bad years. You suffered through the pain. Be prepared to enjoy the gain. Bull markets follow bear markets. Bear markets are the authors of bull markets. And the bear market that we've just been through, I believe, is the author of a pretty incredible bull market coming.
In your opinion, is there more cash on the sidelines ready to come in at this point, or are people spent, in your opinion?
Not spent at all. There's tremendous, tremendous dry powder just in our network. But importantly, Sprott, and you're aware of this, Sprott went out last year to raise an institutional lending fund, the first institutional fund that we ever raised. The first 12 months were fruitless, knocking on doors for no return. But ultimately, in terms of including sidecars, we raised over $800 million. There's a tremendous amount of money circling the natural resources space. More than adequate amounts of money. It's a function of having the correct opportunity, the correct management team, meeting the correct investors. There's a lot of money out there. There's a lot of opportunity out there. Markets are messy. It takes 2 or 3 years to get it right, but it's coming.
So I've interviewed a lot of project generators over the course of the last year. Seems like there's another one born every day. What's your opinion on them for our investor audience, if you would?
Well, the prospect generators, the people who use their management acumen and other people's money to explore, is arithmetically the most intelligent way to pursue the exploration business. It's important to know that not all prospect generators are the same. Many are what I would call, and pardon the pun, constipated generators, meaning that projects come in, but they never get them out. You need to pay attention to explorationists who are serially successful and whose success is evidenced because of their ability to attract major mining companies to joint venture their projects. In other words, if there are 40 prospect generators in the investment landscape, 10 will be worth investing in, not 40.
We're in 2017, right? It's a little bit over half done. How do you see the year ending, and what do you think the 2018 is going to look like?
I think 2017 will be choppy at best. I see in the very near term continued contraction in the natural resource markets. By the way, you're asking me a question well above my pay grade, but since you asked, I'll answer. I'm quite optimistic about 2018, at least in our own portfolios, because we've tended to confine ourselves not to the market in general, but to companies in particular that we see utilizing the cash that we've provided them, the capital that we've provided them, in very, very constructive ways. You know, one of the things that many people get wrong in the resource business is they don't correlate their time expectation with the time required to add value. In my experience, you make money in junior resources by answering unanswered questions. And in my experience, the time required to answer an unanswered question is 18 months. For an investor that has trauma holding stock over a long weekend, the probability that they will be able to hold onto a stock for the time necessary to realize the reward seldom occurs. What's happened to me, and I think happened to you, Shelley, as a consequence of being on Earth for a long time, is that an 18-month time frame seems less daunting to us than it once did.
You know what? For more information, let's get your website out there so our audience can come and visit.
Delighted. www.sprottglobal.com. SPROTTGLOBAL.com. Pay attention to the offer to subscribe to Sprott's Thoughts. I guarantee you'll get your money's worth because it's a great publication and it's absolutely free.
Ladies and gentlemen, Rick Rule, helping me do a Wall Street view of today's, I guess, optimism. Wouldn't you say?
Absolutely optimistic.
Exactly. He's from Sprott U.S. Holdings. It's a publicly traded company on a Toronto Stock Exchange. SII is the symbol. I'm Shelley Craft. This is SNN Live, and we're coming to you from the Sprott Natural Resource Symposium 2017 right here in downtown Vancouver. Thanks, Rick. Always a pleasure.
Shelley. Thank you.
You're welcome.